Good afternoon. Peter Klein, Chief Investment Officer, co-founder, ALINE Wealth, with you this evening on the 26th of March, 2024. Happy spring. It's getting there. And I welcome the opportunity to share with you some of the thinking that we have come across over the course of the last 30 days. And to provide that, I'll share my screen and we can begin the discussion. Please stand by. Okay. The title of this talk is The No Landing versus Soft or Hard Landing, the no landing, but with sticky inflationary winds. What I mean by that is we don't believe that the interest rate cuts that were so pervasive in the thoughts of investors back just 4 or 5 months ago, which was the fuel, a good deal of the fuel plus AI, to this rally that we've seen. It was gone from 6 cuts in November of last year to where now they're thinking that it's closer to 2 or 3, and many folks believe it's maybe 0. Part of that is the fact that we have had a pretty strong economy with inflation not going down so quickly. This slide shows you what our thinking is really coalesced as. It's a new regime, and that requires some new thinking or a new playbook. As I said, the wind is no longer at our backs. That wind is essentially the zero interest rate policy that has been the fuel to the equity markets and to the bond markets for 15, 20 years. I mean, it's been low, and then it went to even lower since the great financial crisis. We don't have that any longer. Now we actually have normalized interest rate policy, and that has implications. We need to be more active and engaged. We have to understand what we own and why we own it. We have to understand the theses behind our thinking. We're no longer, sort of throwing darts against the wall. I know it may seem like that, that the action in the markets these days are getting a bit frothy. Be careful. And no longer can, and this is obviously emphasized here, no longer can a fiduciary-centric investment management system be orchestrated passively or through simple momentum. It doesn't work. Not to the fiduciary, it doesn't. It's hard to rationalize aggressive positioning in this market, period. To do so, you're putting your clients' assets at risk. Not to say you want it to be out, you simply want to be mindful of the risks that are out there. Conditions have changed, right? No longer do we have TINA. Do you remember who TINA was? There was no other alternative to stocks. You were not getting any return anywhere else. Remember those days of 5, 6 years ago? Not even. 2019, 20. You were getting 0 on your money. So there was no other alternative. TINA lived. That's not the case any longer. Our capital, our cash is getting us 5%. Thereabouts, and T-bills and money market accounts, CDs. So there is an alternative, and that's a risk-free alternative. That's important. Deglobalization is now very much part of the discussions and part of the world. The outsourcing for the last 40 years of inflation that shepherded in the disinflation over the last 40 years since the 80s has been deglobalization. The United States and developed economies were able to export their inflationary pressures to the emerging markets that they were then called the third world. Well, far from that today. Nearshoring is more inflationary. We're building plants here to build things. That's inflationary. Labor strength is on the rise. Now, this is not a comment if that's bad or good. That's not my purpose here. My purpose is to understand the economic implications, and they are inflationary. Higher labor costs are obviously inflationary. But the biggest thing that we've sort of looked at as being a factor into this sticky inflation call is the ESG and decarbon mandates. And with the demand that we're seeing to electrify the earth, to bend the curve that is warming the earth, we're seeing that that demand so strong, and yet there's no supply to handle that demand. And that's where inflation stays. When there's a demand supply imbalance, price goes up. So, as we'll see in a moment, our playbook is very much more value oriented, more focused on fundamental analysis, as I said, rather than simple indexing or momentum. More resource-based companies that have pricing power. Commodities, for example, have been an increasing allocation in our accounts, in our portfolios. And we're cautious on high multiple growth stocks, as well as we're cautious on bonds for the reasons indicated. This slide really depicts the story of the new regime. From the end of World War II to 1982, when Newsweek had on the cover of their magazine The Death of Equities, which is the way you knew that the equity market would have a run of historic nature. From that post-World War II period, remember, we came into the mid-40s, early 50s with a lot of debt in our economy, and here we are, we saved the world from fascism, and we built this greatest economy, but there was cost to that. And interest rates went up, and they went up from 45 to 82. You had that inflationary 70s in there as well. And during that period of increasing 10-year bonds, increasing yields, the S&P 500 grew at a 5.7% CAGR, okay, compounded annual growth rate. Okay. But people weren't really heavily invested in equities at that point, by the way, because they were still afraid from the Great Depression the 15 years prior. So they were typically in savings accounts and in bonds. Those that ventured into mutual funds that were somewhat of a new industry at the time, they did better than most. But the average return was like 5.7, and that's largely because you had interest rates going up. Well, then when Mr. Volcker whipped inflation, and the globalization that I had mentioned earlier certainly helped, and women coming into the workforce kept labor prices down. That helped. Technology, oh my God, what a deflationary agent technology had been in the 80s and 90s. Can you imagine? A typewriter versus a word processor versus a computer, having it on your phone 25 years later. Very deflationary. So that period ushered in this great deflation, which allowed the Fed and the Fed governors, and the Fed chiefs to continually lower interest rates. And folks, lest you've forgotten, lots of good things happen to paper investors in bonds and stocks when interest rates, the price of money, that's what an interest rate is, the price of money, gets cheaper and cheaper and cheaper year after year after year, decade after decade. Lots of good things happen. Multiples go up. People spend more. Interest rates are low. Fine, let's go ahead and make another acquisition. There's a problem, a crash, whatever it might be. Lower interest rates, flood the market with more and more money. That's what happened. The Fed put, right? And that was on the heels of this great disinflation. Well, that stopped in our view. It stopped in 2020 when the Fed flooded the world, flooded the economy with capital, probably the right thing to do in face of a pandemic, but they didn't take it back soon enough. And then they came back and added more to it. That's what happens. And what comes from that is the inflation monster gets his fangs into the economy. The genie is not so easily doesn't get back in the bottle so easily. And that's where we are. So this is where we're at right now, in our view. And so the playbook is positioned as follows: overweight cash, respect volatility, Cash is getting us a return. It's riskless and it has optionality value. You could use that whenever you need to use it in order to buy at better prices. Fixed income is not the ballast it once was. It had the greatest 40-year run ever, right? From 15, 16% CDs back in 80, 82 to zero in 19, 18, 19, the greatest bull market in credit ever. Well, I think that's done for a bit. And I say it's flattened down. And so therefore, I'd rather, reduce exposure or not have massive exposure to longer term debt, longer term bonds. Now, tax-free bonds, municipal bonds, notwithstanding, there are spots for that. It's a different type of asset class because it's more for individuals, not for institutions. So there very well may be opportunities there, and we're looking at that. Dividend growth, value style, high free cash flow yields. When we do our screening, when we do our work in our investment committee at ALINE Wealth, what we do is we look for free cash flow yield, high free cash flow yielding securities. That's one of our big screens. Because cash flow is the true lifeblood of a company, of an enterprise. It's the best measure of that lifeblood. It's the best measure of value. Inflation-centric sectors like real assets, infrastructure, resource companies, companies with pricing power, and of course, the water sector, which has been our favorite for decades now. Pipes, pumps, valves, utility companies, desalinization, we'll see in a moment, testing and metering companies. A lot of good stuff happening in water. Go to our website, you'll see a lot of our white papers on that. Okay, so this is the inflation backdrop. Historically, it does come in waves. As you could see, it has done in the previous occasions in 1910, 39, 72. You have these wave-like formats. And so we suspect we're going to see another wave as well. In addition to the inflationary concerns, we also have concerns about debt. And we have substantial debt, as you know, in our system. I've spoken about that ad nauseum. So there's a lot of information about that. It's not pretty. And now, because of the interest rates going up, they're refinancing that debt at higher interest rates. That's a problem because now it's becoming as expensive to service our debt as it is to manage our defense industry. And that's a problem. And it's inflationary. Where are we finding opportunities? There's always opportunities. We're always finding opportunities. We're doing the work to do that. And so here's some things that we're looking at. International markets have been left for dead. Since the great financial crisis, it's been US all day long. And hey, listen, I drink at the trough of American exceptionalism just like you. But, when you see these values and these valuations of these great blue chip companies that just happen to be in France or UK or Japan, developed countries, Italy, and you say, wow, these are 150-year-old companies, great businesses. They operate around the world. And yet their valuation is a 50% discount to the US counterpart. That doesn't make sense. That's an opportunity. We see that here. We see that here. We see that here as well, where you see the discounting getting wider since 1995. And then you see that with the value side. This is UK steep discount in the UK stocks versus the MSCI USA. And here we're seeing Russell value versus Russell growth. So the combination of both value and international is interesting to us. And we like United States value over, as I said earlier, over growth too. So therein lies some opportunity. Otherwise, in thematic approach, we run these thematic models and portfolios for our clients. The water sector has certainly been something, as I said earlier, that's been exciting for us for years. This is a slide that speaks to the desalinization industry, essentially taking salt out of seawater and supplying the needed areas with that water. It's expected to go from 45 million cubic meters per day to 61 million by 2027. Pretty substantial increase. All these facilities that are going to be built, guess there are lots of companies, or I should say a few companies that actually supply these infrastructure construction institutions and and these companies with the stuff that they need to build these plants. What a business. That's a long-tailed business. So we like those. And we like gold in here to some degree. We think it's an interesting asset class. We're not gold bugs. We understand the issues with it. We like the miners to some degree. They've found free cash flow religion, it seems, and there's some good valuation opportunities there, also with commodities. And again, given the sticky inflation call, that would make sense. But folks, if you think you can time this market, if your takeaway from this talk is, oh God, ALINE is concerned, and his chief investment officer there is he's very concerned about the markets, and so I should sell everything. No, that's not what we're saying. Okay, this slide speaks to that. 1980 to 2000, 40 years plus worth of data. If you had 10 grand in January 1st of 1980, you did a Rip Van Winkle for 40 some odd years, you woke up with 952,000. Nice. It's probably about 10% a year on average, maybe a little bit more. If, however, you listened to a video or TV or someone you respected, or you read some article, or you just felt like, you know what, I got a gut feeling that things are too high or what have you, I'm going to get out. And by the way, throughout those 40 years, there were plenty of things happening in the world that might cause you to do that. I get it. And you decide to just get all out. The key term there is all. And it just so happens that you happen to miss just five over all those days. 5 of the best days, because you don't know when the best day is going to be. And your portfolio return goes down by 38%. That's amazing. It's mind-boggling. If you miss just 50 days, you're down to 68 grand, if you can imagine. We don't know when the best day is. So what we want to do is keep a core portfolio, but work the edges. What that means is when people are dancing and no one cares about risk, and when people just frothy behavior, there's a story going around these days, about a particular company that was merged into a shell company. And now that valuation is like $8 billion or something, the market cap of that company. And yet they simply have about $3 million of revenue, not earnings. They have no earnings, revenue versus $8.5 billion of market cap. So you decide that, because of the market being like that, and because maybe there's some valuations that are just too high, you decide to pull back a little bit. Well, we keep a core. We keep our favorite positions. We reduce them. We trim them back. Active management. We do it with a tax efficiency bias, but we do it. And we have some more cash for dry powder, if you will, for a rainy day or for when that fat pitch comes and there's an opportunity to buy low, right? Same token on the other side. Markets get creamed. We're down. It's 2009 or, the bottom of 2022, and we decide, things are fairly cheap right now. Market's been slammed. We're getting some good values here. There's some really good opportunities. Let's increase our allocations because of that. So that's active management. It's not in or out, all or none. It's working the edges in a contrarian fashion. You buy when everybody else is running scared and prices are low, and you don't chase. You don't become you don't join the herd. And when everybody's going crazy, you don't join them. You wait. That's how you make money in the markets, by investing intelligently and buying cheap assets. Simple as that. It's not so simple. Okay. Thanks so much for your time today. Have a great spring season. We'll speak to you next month. Thanks, guys.